What's up guys? In today's video, I wanted to share how I set my ranges for concentrated liquidity pools. This is one of the questions that I get asked all the time. And if you're new here, my name is Richard. I'm a yield farmer and investor. If you want to take a peek at my portfolio, you can look at this portfolio update playlist on my channel. I usually update this once a month, so be sure to check that out if you're interested. But in this video, I will share my simple process of setting ranges, as well as a few examples to go along with it, so that hopefully it makes it really clear on how to set your own ranges. But the thing to keep in mind with setting ranges is if you're not doing it right, you could be giving up a lot of your upside or be exposed to a lot of the downside. Setting a bad range is one of the ways that people lose a ton of money from yield farming concentrated liquidity pools. So be sure to watch this video to the end if you don't want to make these mistakes. And like always, this is not financial advice. Please do your own research before making any investment decision. So the range you set would depend on the goal you're trying to prioritize. And we can't achieve every goal, right? For example, if you guys want more asset appreciation with your liquidity pools, you will have a wider range compared to if you're prioritizing APR. So a great example of this is a Ethereum to USDC pool that I'm currently in. My bottom range is at $2,500 and my top range is all the way at $100,000. My entry was around $3,500. And the reason why I entered in that range is because at this $3,500 mark, that's the comfortable price that I want to start selling my Ethereum in. So I swapped some Ethereum to USDC to have some stablecoin allocation. And then as Ethereum's increase in price, as long as it's below $100,000, it's slowly getting sold to USDC, right? And I'm earning capital gains in the process. And you can see this position here. So I actually went with 2,300. I remembered wrong. It's not 2,500. But you can see the max range is $100,000. And in US dollar value, from the time I deposited, you can see because Ethereum moved up in price, I'm up $12,700 something right now. So 28% ROI on my investment, while I'm earning 13 to 14% APR. So better than just staking your Ethereum and better than just lending out your USDC. But at the same time, I'm suffering some impermanent loss, right? Because a lot of these crypto to stable pools, they have a directional bias over the short term. So it's very likely that you will be suffering some impermanent loss. It's not a big deal here. You can see I'm down only $700 something, especially because Ethereum kind of moved up pretty aggressively. And I don't mind that because you can see I'm down only 1 point something percent compared to holding. And my goal is not to compare myself against holding for this pool, right? My goal again is capital gains and slowly selling my Ethereum on the way up. So it makes sense that I would be underperforming just holding Ethereum separately. But at the same time, the benefit is if Ethereum goes up by a lot, I miss my exit and then it drops back down, I would make much more gains than trying to time the perfect top, right? And the reality is we never know what's going to happen in the market. That's why I like to use this liquidity pool rather than just holding on to my Ethereum, waiting for higher to ultimately sell, right? And this position has been live for 29 days. I haven't claimed any fees. You could see it's earning me $500 that I could use to reinvest or pay for my expenses during this whole time. You don't really have that cash flow if you just buy and hold, right? You gotta constantly sell your holdings to be able to use the money versus just sitting in a liquidity pool. And when I told some people hey, is that range not too wide? 100,000 is pretty crazy, right? You guys see people set ranges all the time. Some people set let's say the price is here, they set maybe 4,200 to 4,800, trying to squeeze the APR. But let me show you guys the difference here. So let's say you're putting $100,000 and price now, let's say we start at 3,500. That's when I deposited. And let's just say it's trading at that price. Price lower, 2,300 is what I had. So let's just say my top range is only $7,000, right? Maybe that's where you expect Ethereum to top out the cycle. And we can take a look at the capital gains. So we started with 100K. So if I click on this line and the top gray dot here, you can see I would have only a 25% of capital gains, right? Because I started with 100K, now it's 125K. So not that much capital gains, especially because we see Ethereum basically doubled in price. So if I change the price now to $7,000, you can see you would have 22.2% in permanent loss. And again, with these types of pools, we're typically not trying to outperform holding here. We're just earning some cash flow or trying to sell our Ethereum on the way up. But let's say I make only one minor adjustment, right? I change the upper range to 100,000 like what I had. You can see the impermanent loss dropped to only 9.5%, and my capital gains jump all the way up to $164,000, right? A huge difference here, roughly 64% of gain compared to the 25% gain. And this is particularly good if I expect the price to move up aggressively over the next 6 to 12 months. The capital gains is going to be much greater than any APR that I would earn because it takes time to earn APR and you need to be in range for an extended period of time to be able to accumulate the fees, right? And this is especially true if the price of Ethereum blasts past 7,000 to maybe 10,000 or above. You could see even at $10,000, I am suffering higher impermanent loss here, but that's okay. I would basically double my holding while selling my Ethereum in the process. And if I change the price now at 3,500, you can see in this case, I've already sold roughly 18 to 20% of my Ethereum when I deposit it. This is this Y value here to secure some profits at the $3,500 mark. So my capital gains would be less than if I just did a one-sided pool like this, right? So lower range 3,500 all the way to $100,000. If the price goes to 7,000, like what we were looking at, your cap gain would be at 78, 79%. So it depends on your goal. If your goal is to have more capital gains, typically I like to set wider bullish ranges, meaning that you're typically putting in more assets that you're trying to sell into the LP. If I hop back to the previous range here at 2,300 and the previous price now, this is a bullish LP because I'm basically depositing 80 something percent Ethereum into the pool, which is more than USDC that I deposited, right? So that's a very simple example here on setting the ranges. And one thing to note is that I never just look at the daily chart for the ranges. I see people look at the daily chart all the time to try to map out where the prices are going to move sideways. But the reality is you can never know where the prices are going to move sideways. The crypto market is really unpredictable. For example, some people were yield farming really tight ranges here from let's say 2,200 to 2,800, right? They're thinking that the price is just going to basically move here sideways for a long time. But in reality, big moves in the market happen all the time. And you can off balance that by basically having a large HODL bag that you don't yield farm with separately. But if you're doing that, then you're likely not earning a lot of yield on your overall portfolio anyway. So I personally don't like this strategy because then when the prices move up, you either have to basically widen your range if you want less impermanent loss, or you're basically chasing the range upwards here, right? If you're trying to, let's say, yield farm from $4,000 because you expect some resistance there, and then maybe you set the range at $3,000 or lower, right? When the prices move up. But again, the reality is you're going to be in range for only a little bit here. If I measure the day, it's 26, 27 days, not even a month before you're forced to rebalance, right? And it's really dangerous to keep doing this on the way up because if you did that on the way up and the price draws down aggressively, you're going to lose a lot of money when your pool is aggressively being converted back to Ethereum and the Ethereum price drops, right? So this is the strategy to avoid. I like to look at the weekly chart instead, or sometimes the monthly chart to see where the prices are going. So the weekly chart for Ethereum looks pretty extended here, but at the same time, if I look at the monthly chart, you can see there's a MACD cross here, which is typically a bullish sign. And there's not a huge wave of MACD that I have to worry about it being overpriced yet. Same thing with the monthly RSI. I use the 25 period RSI just because I want to have less sensitivity. I'm a longer term investor. I want less noise. That's why I adjusted to the 25 period. But I'm not concerned because it's still below 70. When it's above 70, I want to be a bit more careful because that's when the prices are likely to retrace and maybe the top of the cycle is near there. So that's why I set the bullish range for my Ethereum to USDC LP. So let me show you guys another example here where the goal is to have some capital gains, but at the same time, I don't want to take too much risk. So my range is not completely like bullish. I'm not like depositing like 80-90% of the asset that I want to sell, because if I do that and the asset pulls back really hard against Ethereum, if I'm pairing it with Ethereum, then I would suffer much more losses, right? So this is if you want exposure to the asset, you want more capital gains, but you also want to take less risk. So this is this Pendle to ETH position here. I started off a little bit tighter, but I expanded the range because I want to lower my risk. The initial investment for this LP is around 3 Ethereum. It shows a profit here because it's a rebalance position when I'm in a slight loss. But it's not a big deal because I'm bullish on Pendle. I believe that as Ethereum slows down, Pendle is going to outperform Ethereum. So I'm betting on outperformance here, and you can see my ranges are pretty wide. It's at 0.0003 and at 0.6 here. Current price is at 0.00119. So it's very, very likely that I will stay in range. And if you look at my previous position, the ranges are a little bit tighter here. You can see it's at 0.0006 and 0.003. So quite a big difference here. And again, the reason why I expanded the range is to have less risk and more capital gains. The wider the range, the less aggressive the asset conversion rate would be, right? If Pendle dumps aggressively against Ethereum, my Ethereum is going to be converted to Pendle at a slower pace compared to a tighter range. That's why I went with a wider range. I'm not sure how the altcoin market is going to move. I'm still bullish on like these mid to smaller cap altcoins in the next 6 to 12 months, but I'm going with a wider range because I'm not sure when the bull market is going to end. So I'm not really trying to prioritize the APR here. So if I pull up the range here, previously my range is at like 0.0007 and the top of the range is at 0.003, right? And let me change the new range to this yellow color. So it's quite a large difference here, but we'll go over that in a second. You guys can see if I drop down to the weekly chart, even with the initial range that I have, it's more likely that I'm going to stay in range with this wide range compared to something that's really tight, right? Every single token moves a little bit differently. In this particular pair, you can see Pendle kind of just like moves sideways against Ethereum. Sometimes it outperforms, sometimes it underperforms. It's not as volatile like a meme coin, but it's not really like on a strong uptrend against Ethereum either, right? So this initial range, if you want to take a little bit more risk and trying to prioritize the APR, that's a good range to stay with. Or you could even squeeze the upper range a little bit here if you don't care that much about capital appreciation and you want to squeeze the fees a little bit, right? But here you can see, again, I like to use the weekly chart just to make like the entries more clear. I like to enter when the prices is low, and when the prices are high, I want to consider like taking profits and exiting my position into Ethereum, because that's when we're in Ethereum profit most of the time. And that's when we can close out our position and take some profits. So here I would still be doing pretty good with a tighter range, but I believe that the alt season is coming up soon. If you look at Bitcoin dominance, it's starting to crack down below 60%. Ethereum is really strong, which is like a sign that the alt season is coming, especially if Ethereum breaks all-time high. Then I believe that we're going to see much more price action from these smaller cap altcoins. But at the same time, I'm not sure when that's going to happen. So then I widen my range, right? I have like a lower range here all the way at 0.0003 and my upper range at 0.6. Really wide ranges here. And it's still a bullish LP because if you guys look at this current asset here, I have more Pendle in Ethereum terms compared to the Ethereum that I deposited, right? So I'm trying to bet on Pendle's outperformance. And as Pendle outperforms Ethereum, I would be able to stack more and more Ethereum profit. And again, I went with a wider range because it's safer. If it drops in price aggressively against Ethereum, I would suffer less Ethereum losses. And then if it outperforms Ethereum by a large margin, let's say it starts breaking out in this key zone of resistance here, starts trending up against Ethereum in altcoin season, I would be sure to aggressively take profits and consider like exiting my positions completely if I believe that the prices are going to draw down pretty aggressively, right? But in any case, if the price goes up aggressively, I would be making much more profits. So now let's look at some other pairs here if you're trying to prioritize the APR. So one example of this is, let's say, Solana to Ethereum. If I go to the weekly chart, you can see this is pretty much like a trending token, right? It's either trending up or trending down. In this type of token, we typically don't want to squeeze the range too hard. The reason why is you're going to be suffering a ton of impermanent losses and a ton of Ethereum or Solana losses, depending on what you're trying to prioritize and depending on if you're right about the trend movement, right? So if I were to enter into this pair today, maybe my lower range would be at this zone of support here at 0.03 or even lower here before Solana broke out against Ethereum at 0.025. So this could be a pretty wide range strategy here where I try to basically have less risk, but I'm also not setting like a max upper range or a really high upper range to get capital gains, right? I might squeeze the top range here to be at 0.09. Try to stay in range for as long as possible. I personally like to stay in range for at least 6 to 12 months. Of course, we can't tell the future, so sometimes I'm out of range before that. But at the same time, if I'm looking at the weekly chart or the monthly chart to set my ranges, it's very likely that I would suffer less impermanent loss, outperform HODL, and also be in range for at least 6 to 12 months at a time. So pretty good entry here. If I'm swapping from Ethereum to Solana, I could be yield farming this pair with decent APR with this type of range here rather than an even wider range, right? Sometimes I go even full range if I want to take less risk. I want exposure to both assets, and I also want decent capital gains if the prices go up aggressively. And let's take a look at some other examples here. Let's say it's Bonk and Ethereum. This is a pair that I'm currently in. So for this pair, my ranges are really wide once again. But if I look at the weekly chart, you can see there's like a clear zone of resistance and a clear zone of support here. The chart looks a little bit like Pendle, right? It's a little bit more volatile. But if I want to prioritize APR, I still want to be looking at the weekly chart. Maybe my top range is here at this 0.125 E minus 7. And then if I want to have a little bit more safety here and bottom side, the range could be around 0.3, but it's E minus 8, right? So this could be a tighter range strategy if I'm trying to squeeze the range a little bit. And of course, if Bonk is going up really high, I would miss this wick up. But in my opinion, this is more of an outlier because most of the pumps, people just sell at this zone of resistance, right? If I'm trying to prioritize fees, then I want to basically stay in range here with this type of range. And if I just want more capital gains, again, I would have a wider range. And another tool that I really like is using the Bollinger bands. And I typically like to use these bands on like the weekly or the monthly chart. Again, I don't think these indicators are very useful on the daily chart because Bollinger bands basically shows you like the volatility. When it's starting to squeeze here, like what you see back here in June, it means that the prices are less volatile. It's calming down a little bit. But the way the crypto market works is that when the prices squeeze, it typically means that like a big move is coming soon. So what a lot of people do is they just look at like the daily Bollinger bands to like try to set the ranges. I think that's a mistake because you can see sometimes like the Bollinger bands are really wide. That's when the prices are volatile. So if you're entering in the pool there, I still want to have a pretty wide range. But what's really going to like get you into trouble is let's say you see the Bollinger band to be really tight here, right? Of course, you could set like a really tight range there, to try to capitalize on the fees if you're a shorter term yield farmer. But at the same time, again, you never know like how long the prices are going to move sideways. Back here, the prices kind of move sideways for a long time. Maybe you would outperform like wider range strategy. But then again, when the price moves up pretty aggressively, you're missing out on the exit. You gotta wait for the prices to go down before you start yield farming with tight ranges again, right? And then here, you're going to have less fees because the price pretty much didn't like move sideways too long before it pumped back up. So right now, the price is kind of trading near like a zone of support here. My entry is around that green line. Not a big deal because a lot of altcoins have been underperforming Ethereum here in the last few weeks. But I'm not really going to use a really tight range for this pair either, right? Because even though the price could like stay sideways here for a while, you just never know when the prices are going to stay sideways. You only know that after the fact, right? So if I look at the weekly chart and use the Bollinger Bands, one way to use it is just to set your ranges with this red line and then this green line. And typically I want to look and see if like this Bollinger Band makes sense as well, right? So if I look at Pendle here and turn off the log chart, if I go to the Pendle to Ethereum pair, if that's what I'm trying to yield farm with, again, this Bollinger Band is something that I could set my range on, but you could just look at it with your eyes and map out like the key area of resistance and support too, right? If you're trying to basically maximize the fees. And sometimes for more volatile pairs like crypto to stable pairs, like Ethereum to USDC, I could use a weekly chart for the Bollinger Bands, but really when I see like squeezes like this, I don't really like to basically set my ranges based on the weekly Bollinger Bands. What I like to do instead is maybe move up to like the monthly chart. And you can see if I go with a wider range, that is prioritizing fee. You would have a pretty wide range here, right? All the way at $1,500 for the bottom. And then maybe a little bit higher than what the Bollinger Band is because Ethereum has been really strong. Maybe the upper range is around 6,000 to 7,000 if you're really trying to prioritize the fees. And lastly, if I want to take more risks and have more rewards, I want to typically have a directional bias when it comes to yield farming these liquidity pools. For example, with my LP, again, I'd put my range at the bottom at 2,300 and the top all the way at $100,000, right? But if you want to take more risks with like a directional bias, a possible range could be around like 8,000 if you're trying to capture the upswing, right? And maybe the bottom range is around 3,500 if you're prioritizing some fees with some directional bias here with your liquidity pools. Because when we have a directional bias, we're going to be making more capital gains. But if you're wrong with the direction, you would suffer more losses as well, right? No strategy is perfect. That's how I set my ranges. It has worked out pretty well for me in the past. And to me, tight ranges just doesn't make sense. The crypto market is very volatile. There's a lot of leverage baked into it. A lot of times when there's like low periods of volatility, you never know when the prices are going to be more volatile once again. So I hope that was helpful. Be sure to check out my other videos if you are interested in yield farming and investing. And if you've been watching for a while, you really like my channel, it would also help me grow my channel really quickly. If you know a few friends that would benefit from this type of content, I would really appreciate it if you send these videos out to your friends. Thanks for watching, guys. I'll catch you next time.